All right. Okay. Good afternoon, everyone. Um, so yesterday we were able to see a few things. We were able to see what the financial market is. We were able to see what it is. We were able to see the major players in the financial market who are those that trade. We're also able to see examples of currency pairs, and I can remember that we went through the basic currency pair, like the major currency pairs. We're able to see that. I remember that pie chart that I was showing you yesterday. So yesterday we were also able to talk about PIP and lot. Much later today, we are going to go into PIP and lot more properly, particularly lots actually, and then I'm going to be like recording a video, and I'll be uploading it later for you guys to further explain, pips and lots. I remember that I mentioned yesterday that price moves in pips. So I remember that I mentioned yesterday that price moves in pips. So we just try to take it further from there today. Let me just get to sharing my screen. A moment, please. All right, so I believe you can all see my screen now, and we are just going to we are just going to take it from there. So we stopped around here yesterday, and we saw how that market you are either buying or selling, and that the essence of of learning, the essence of the training is so as to know when to buy and when to sell. And I think I made mention of the fact yesterday also that um the buyers are called the bulls, while the sellers are called the bears. The buyers are called the bulls, while the seller are called the bears. And I think then we're able to see, we're able to move further from there. We're able to move further from there so that when the market direction is bullish, it means that it is it is buying. We saw those words yesterday. I think we used about three different terminologies. We used it is bullish, it is buying, or going long. So, and I think I made an example yesterday that if I say that I was using GBP USD as an example, that if I say I am going long on GBP USD, what it means is that I am buying that market. And don't forget how we started. If you followed the class closely yesterday, that we saw that when you are when you are buying the reason why you are going to be buying a particular market is because, let's take a currency pair, GBP USD, for example. The reason why you are going to be buying it is because from your informed decisions, you are of the opinion, you speculate that the GBP is going to gain is going to rise against the USD. Now, in situations like that, if that is your speculation, you go long on that market, you buy the market, you go bullish on that market. I believe we get that. So those are like understand those terminologies, because the reason why these terminologies are going to be very important, why you need to pay attention, is because when we start, I was the day before yesterday, and I think I re-emphasized it, made a rehash of it yesterday as well, that we are going to be dropping signals and stuff for you later on. So imagine I'm on a group and I'm dropping it, I'm telling you, go bullish on this particular trade. Somebody cannot be asking me, you can't be asking me, what does that mean? What will I do? No, 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 please. And that is why this training is important. So if I'm saying that buy that trade, it is the same thing as go bullish on it. It's the same thing as go long on it. So now, for example, now imagine you ask me that how is a trade doing? Let's say what is happening on Euro USD. All right. And I say, Euro USD, the bulls are winning. If I say the bulls are winning, what that means is that the market is buying, it is going up. Look, like you can look at the screen I am sharing on your screen presently. It says market direction is bullish. That means that the bulls are in control, of the market. Now, yesterday I made mention of PIP yesterday, if you can remember that I made mention of, and I said that price moves in pips. Price moves in pips. Now, you look at the far right end of your screen, those numbers that you can see. I think you can see the black line that across the screen horizontally is 1.4012. 1.4012. Now, when you look at that now, those things 1.4, 1.4, 1.4 something, 1.3 something, that is on the far right hand side, that is what we call price in the financial market. That is price. So the movement of price. So when price goes 1.4012 to 1.4013, price has moved by a pip. Now, I want you to pay very good attention to me. I'm still going to do a pre-recorded video and upload it for you so that you can watch this and understand it very well. But I just want to lay a foundation about that. So now, I want to believe that you can all see the movement of the mouse on the screen. Now, if you look at this place where the mouse is now, the mouse is on 1.3909. But current price now, that this black line now, this black line that you can see mini black line that is 1.4012, that is where the current price was when this picture was taken. Okay, no, so if price moves from the, look at this tall bullish candle, you should be getting familiar with the terminologies now. So this tall bullish candle, now if you see this, if you look at this tall bullish candle closely, let's say the beginning of this top bullish candle is a little bit lower, somewhere in between 1.3909 and 1.3895. But let's just assume that it starts from 1.3909. If we want to calculate, so if you want to calculate the number of pips that this market has moved for, like the market is bullish, so it has gone long for about 30 pips, about 40 pips, about 20. You're going to understand the significance of that as we move on. Now, the way you calculate that is you do 1.4012 minus 1.3909. That way, that is how you get the number of pips that this particular market has moved. Now, wanted to lay that as a good foundation. I'm still going to do probably a short video. It might be short, it might be long, where I'm going to like take my time to explain this very well and then give you assignments in that regard. So let's move on from there. We have a number of things to touch today. Um, Now, there are basically three. Okay, before whatever it is that you are seeing on your screen, just ensure that you are listening to me. Now, there are basically three types of markets. All right, there are basically three types of of market movement, or the what I can say, market structure, the way the market moves. All right, the way the market moves. Number one, you have the uptrend. You have the uptrend. Number two, you have the downtrend. You have the downtrend. Number three, you have the ranging market. I go again. Number one, you have, now in case you feel like that's why I expect that you have your notes and your pen with you that you are writing with, or something that you're like a notepad or something that you are taking things down, because the slide that I'm showing, you would have noticed a number of things that I'm saying is this. The slide is a guide. All right, so the slide is at best a guide. So what I'll be saying, I've been noticed from yesterday, I've been saying things that are not necessarily in the slide. Okay, so back to what I was saying. So the market basically, like three different kind of market structures that we have. You have three. I'm going to add a fourth one later, but let's just stay with that now. So you have the uptrend, you have the downtrend, and you have the ranging market. The ranging market. So you have the market is either in an uptrend, in a downtrend, or a ranging market. Now, let's see what does uptrend mean. As you can see on your screen, when the market, if we say a market is in an uptrend, what does that mean? Now, it means that the market is forming, the movement of price is forming series of higher highs and higher lows. The movement of price is forming series of higher highs and higher lows. Now, what does that mean? See the next image here. You can see this labeling. So market is forming higher highs and higher lows. Now the HH you can see on your screen. I believe you should be seeing that now. So you should be seeing the HH now on your screen now. Okay, I think so. The HH you can see on your screen. It's how do I put it now? It's a is what's the word? It's an abbreviation, all right, for higher I. Do you get? For higher I. Do you get? For higher I. Why the HL is means represents higher low. The HH is higher I. The HL is higher low. Now, two things you will note that the market keeps forming. This is a typical example of market being in an uptrend rather. So it means that you can notice that the market, another way we can say this is that the market is bullish. Do you remember? I made mention of that earlier. So this market is a bull market, is a bullish market. Why? It is forming higher highs and higher lows. This market is in an uptrend. Why? It is forming higher highs and higher lows. This market is in an uptrend. Why? It is forming higher highs and higher lows. I go again. The market is in an uptrend. Why? It is forming higher highs and higher lows. Higher highs and higher lows. Now, in when the market is in an uptrend, what do? You look for opportunities to buy. All right, you look for opportunities to buy. Basically, you do what the trend is doing. All right, so if the market is in an uptrend, you make sure that you are going up. If the market is in a downtrend, you make sure that you are coming down. Do you get? So there's a popular statement like that we use a lot when we teach. We say the trend is your friend. Do you get? The trend is your friend. If you make the trend your enemy, it might be your end. You are not getting it. If you make the trend your enemy, it might be the end of your trading career. So it means that when the market is trending in an uptrend, you follow it. Be a good follower. Follow it. All right. When the market is trading in a downtrend, as we are still going to see, you also follow it. All right. So when the market is in an uptrend, what are we looking for? We are looking for opportunities to buy. Now, you will notice that I did not say when the market is in an uptrend, just buy. Enter. Only okay, new, only okay. Apologies for those that don't understand Yoruba. But only okay, the market is just going up, it's going up, it's going up, it's going up. I don't want to miss the market. Oh, boom. You just enter. You wipe your account. All right. So what I said was that when the market is in an uptrend, you look for opportunities to buy. You look for opportunities to buy. When the market is in an uptrend, you look for opportunities to buy. Now let's move on. When the market is in an uptrend, you look for opportunities to buy. Now look at this. Look at this particular image now. Just like I was explaining to you earlier that you are entering when you are buying. Another way to say that is that you are entering a long position. You are entering a long position. You are entering a long position. So look at it now. This place, you can see this how should I put that? Let's assume that this place that you can see the red line, that is your entry. Let's assume that where this red line is, you can see that the red line across the screen is labeled 1.4000. That's what it is. In case the drop down is affecting the way you see the drop down in the corner is affecting the way you see that. So what is in that red place is 1.4000. Now, so let's assume that somebody now joined this market but went long, entered a long position on this market at that point, at point 1.4000. Now, market now moves to the current price. The current price is 1.4039. Now, if market moves, from where you entered till this point, that explanation of pip that I was doing earlier, by now, so how do you know how much pips that the market has moved? That how much in how by how many pips have price moved away from your entry? Now, in a favorable position, obviously. Now, it is now going to be 1.4039 minus 1.4000. So in this instance, price has moved by 49 pips. Now you see my mouse now. Price has moved by 40, no, sorry, 39 pips. 1.4039 minus 1.4000. So price has moved by 39 pips. Now, very soon you will understand the significance of what does it mean when we say price has moved by 39 pips. You get that. Let's just move on. I have a number of things to share with you today. Just I have a place I need to get to in my slides today. So like in the slide that we have, so see how that goes. Now, this is when the market, this is just like an illustration, all right, showing you that when the market direction, we talked about market direction earlier, that you can have your uptrend and you can also have you can have your uptrend where the market is set to be bullish, and you can also have your downtrend where the market is bearish. So this is kind of example, the red candles. See that? Those red candles. So market direction is bearish. Market direction is bearish. So move on from there. So when the market direction is bearish, now look at this example now. So you now open a short position. So let's assume that, so your entry now, okay, so your entry this time around is up a 1.4015. As you can see, 1.4015. So, and the market kept coming down in your favor. Now, because the market kept coming down in your favor, all right. So, because the market kept coming down in your favor, what you then do is that imagine that the market now got to 1.3979. So, how do we calculate the number of pips that market has moved by? We do 1.4015 minus 1.3979. What the answer that we get, that is the number of pips that price has moved in within that period. So I'm going to go again with that. So this is a short position now. When you go short, you are going bearish, you are selling, you are going down, as you can see on your charts now. So when you go short, you are opening, you are selling. Did you get see? Look at what I was using. I said open a short position, sell and enter the market. Did you get? So a short position means that you are selling. If I say if somebody texts me and say, boss, what should I do on I'm checking USD JPY. What should I do? That's United States dollar against Japanese um Japa, Japanese yen rather. And if someone now says that boss, I'm checking checking this particular currency pair. What should I do? I now say that go long or go short. You have to understand what I'm saying. So when I say go long, I am saying buy the market. When I'm saying go short, I am saying sell that market. Now somebody is asking me here that do you buy? No, not necessarily. You don't buy pips. All right. I'm just I just saw the question in the comment section now. No, you don't. The person probably was not around for the class yesterday. We say price moves in pips. Price moves in pips, not that you don't buy pips. Price moves in pips. So if price moves from, look at on your screen now, look at this 1.4015. Let's assume that that is where price is, and then you do something, then you check the screen again, and price is now on 1.4016. What that means is that price has moved by a pip, by 1 pip. All right. So if it goes from 1.4015 to 1.4025, price has moved by 10 pips. So, so I think I just needed to like clarify that. And so let's move on. So as I said, when you open a short position, it means that you are selling. You want to sell the market. Don't forget, largely we are talking about market structures and all that. So now this is a downtrend. We talked about what the uptrend is earlier. We saw what an uptrend is. Now, so this is a downtrend now. So in a downtrend, market is forming lower highs and lower low. In a downtrend, market is forming lower highs and lower low. Now, what does that mean? As you can clearly see on your screen, that the market is going down, the price is going down. So when the market is in a downtrend, now LH stands for lower high and LL stands for lower low. What it simply means is that the high is, yesterday we were talking about the anatomy of the candlestick, and we're seeing the upper wick, the lower wick, and the body of the candle. So the top of the candle, that is the peak. So the top of the candle, that is the peak of the candle, that is the high, and where it down, obviously that is the low. So when we say market is forming lower high and lower low, you can see clearly typified on your screen how the market does that. So again, when the market is in a downtrend, you look for opportunities to sell. And just as I said earlier, the trend is your friend. That if you make an enemy out of the trend, it's going to be your end. All right. So you have to make sure that you are doing what the trend is doing. Is that okay? So when the market is in a downtrend, you are looking for opportunities to sell. When the market is in a downtrend, you are looking for opportunities to sell. Once again, I'm going to reiterate that. You notice I did not say when you open your chart and the market is selling, is in a downtrend. I didn't say sell. There's a difference between the two. All right. You don't be you won't sell in you, and you just sell. You don't do that. All right. When the market is in a downtrend, what you now look for is opportunities to sell. Now, you will understand the difference between that as the class goes on. All right, so we are back to okay. Just before that, I'm going to I'm going to add a pictorial representation of that also into the pre-recorded video that will be doing about ranging market. I told you that basically we have like three different kinds of markets, largely. Okay, so you have the uptrend when the market is forming, higher highs and higher lows in an uptrend. You have your downtrend where the market is forming lower highs and lower lows. Then you have your ranging market. You can call it a sideways trend. All right. So you have your a sideways market rather. So you have your ranging market where market is moving between a fixed is moving between two fixed prices. Now, don't forget, I've used the word price a lot today, and I explained what it means at the beginning of the class. That thing that I showed you on your left, on your far right hand side rather of the screen, that is the price. Those numbers, that is the price. So when market is moving between two fixed prices, all right, let's say one market is moving between 1.4010 and it's between that and 1.3920. All right. So if you go up, touch 1.4010, come back down, touch 1.3920, go back up, touch one. You get what I'm trying to say? So that particular analogy, I'm going to explain this better when I do the pre-recorded video. I'm going to explain it by way better, but just hold that thought that we have our uptrend. In our uptrend, market is moving, is forming higher highs and higher lows. We have the downtrend. In the downtrend, market is forming lower highs and lower lows. And then we have the ranging market where market moves between fixed prices. The market moves between fixed prices. All right, so moving on. Moving on. I introduced Pip and Lot yesterday. I introduced Pip and Lot to us yesterday. I introduced Pip and Lot to us yesterday. So basically, it says when yeah, it says that as you can see on your screen, it says there are three lot sizes largely. There are three lot sizes. Three lot sizes. So you have your standard lot, which is 100,000 times the base currency. I would explain that. Don't go over your head on that. So you have your mini lot, which is 10,000 times the base currency, and we have the micro lot, which is 1,000 times the base currency. Now the standard lot is one. All right. The mini lot is zero point 0.1, and the micro lot is 0.01. Right, I go over that again. The standard lot is 1, so the mini lot is 0.1, while the micro lot is 0.01. Now there was an example. I'm trying to see the particular slide that is. Okay, I'll get to it. But basically, what it means is that for a standard lot now, every movement, all right, every movement of price per pip is $10. Now, what that means is that now, I need you to like pay good attention here, all right, because when you start, these are around the places where you start your doing assignments and stuff like that. So when a single movement of price in a standard lot is $10. Now, what this means is that I was explaining to you earlier about pips, right? So I think the person that posted that question now, you can see the proper spelling of pips. You get it? It's not like it's PIP. All right. So now, so when we talk about price moving in pips, what it means is that if price move from, let's say, the current price of a market is 1.4000, and price moves from that from 1.4001, what that means is that if you enter that trade, if you are going long, you are buying that particular market, and you are in that trade with a standard lot, with every price movement per pip, what you gain or lose is $10 per pip. Do you get? So it means that I don't necessarily have to say that that trade. I don't necessarily have to say I lost so and so and so amount, or I gained, or I won so and so amount on that trade. I can just say how was the trade? The trade went well. Though. It was good. I made profit. How much profit? 45 pips. Do you get? I'm the one that know how much lots I used. So it is the lot with respect to how many pips the price moves that determines the actual amount of money that somebody makes on a trade. Now, let me paint a scenario, and I need your attention. I need you to follow me closely here. Now, if you go long on a market, and the market favorably moves in the direction that you have speculated for for by it moved by 20 pips, the market moves in your favor in the direction that you speculated by 20 pips. Now, if you don't forget that I said that I said that every price movement per pip in standard lot is $10. Now, on that standard, now a mini lot is 0.1. I told you should have your notepad out. So mini lot is 0.1, while micro lot is 0.01. Once again, I need you to pay attention here. Now, so if I enter a trade and I am going long on that trade, I am bullish on that trade, I am buying that trade, and the trade moves 20 pips in my favor. Now, when the trade does that, if I am in that trade with standard lot, how much will be my profit? It is now going to be 20 pips multiplied by $10. Now, and I need you to pay good attention, because don't forget what we said earlier, that the amount per pip movement, all right, in standard lot is $10. Now, and standard lot is 1. If mini lot is 0.1, that means that per pip movement in mini lot will be $1. All right, because for standard lot is 10, so for mini lot it's going to be, is 0.1 from 1. So 0.1 from 1, all right, will be divided by 10. So per pip movement in micro lot will be 0.1. So if I enter a trade with the standard lot, and the trade moves in my favor by 10 pips, how much have I made in that trade? It is going to be that 10 pips multiplied by the price, by that's the $10 per pip movement. It's going to be 10 multiplied by 10, which is 100. So that on that trade, if I entered with a standard lot, I would have made $100. Now, if I entered with a mini lot, that is, don't forget that now that is $1. All right, Abi, now that is one. That is $1 per pip movement. If it moves, if he moves, 10 pips, I would have made $10. If I enter on micro lot, that is 0.01, 0.1 per pip movement. If he moves 10 pips, I would have made $1. So in that order, that is how you need to understand the lot size and how it relates to the number of pips that the price makes in the market. That the number of pips that the price makes in the market. Of that. So basically, so that's what I'm going to still, like, in the pre-recorded video that I'm going to be dropping here afterwards. I'm going to like explore this a little bit more. All right, I'm going to like explore this a little bit more and use examples, proper examples that you will be able to understand perfectly. All right, so just nextly we are going to be going to I'm just going to introduce this, and then we'll continue in our next class. I'm just going to introduce this now. I don't want to like start it and not get to somewhere very significant today. So I'm going to introduce this. As you can see on your screen, it says three major form of market analysis. There are three major forms of market analysis. So the first, like we have, as you can see around it, we have the technical analysis, we have fundamental analysis, and we also have sentimental analysis. So we have the technical analysis, the fundamental analysis, and we also have the sentimental analysis. Now, basically, I'm going to explain, I'm just going to like touch up on what these three analysis means, and then give examples. So let's start with fundamental analysis. So basically, what is fundamental analysis? Fundamental analysis is trading, analyzing the market. From the word analysis, obviously, is analyzing the market, or analyzing the market to make a trading decision based on based on news, as it were, based on actual live event that is happening at that time. Now, don't forget that yesterday, when we're talking about these other places, when we're talking, I think I made a far reference to the war going on presently between Iran, Israel, vis-a-vis the United States of America too. I made mention of that war and how it impacts on the economy. All right. So, and we saw yesterday also that the economy of the country that we are trading its currency affects the currency. So once it affects the currency, it is going to reflect on the charts of retail traders that are trading it. You and I. All right. So it means that when we talk about fundamental analysis is now analyzing the market to make a trading decision based on live events reported, or unreported. So based on live events that are happening. For example, now, if let's say the unemployment in Japan, all right, if there's a unemployment in Japan just shoots high, maybe the unemployment rate before used to be 15%. You just see a news that the unemployment rate has now increased to 45%. Now, automatically, that is going to affect their economy, and it is going to affect their currency. In other terms, it is going to affect JPY in the charts. Do you get? So a trader can now make a trading decision off the back of that because of this news that I heard, JPY is going to be very weak in the market. Let me go and trade against it. So you can make decisions based off the back of something like that. So when you do that, that is called fundamental analysis. That is what is called fundamental analysis. All right. Then for sentimental analysis, now I'm trying to think of a good analogy to use. For sentimental analysis, is another word you can use for this is that when you are trading like an earthman. That you are like all these herdsmen that people they are the all they are into livestock farming. Basically, I think the Fulanis or the Hausas or something like that. That where you are just carrying their malu up and down, their cows, just grazing, doing open grazing along the time. So now obviously if you've seen the way cows move, you get the cow in front and the cow at the back. There's one in the middle that doesn't care. Whatever you lead, just take me there. All right. So there is that way that we can also make sentimental decisions of what people are doing. For example, now, elections are coming up in Nigeria next year. Elections are coming up next year, and there's a way we Nigerians can be like, okay, elections are coming up, cheap. That way, that you go to the market, you are buying something that probably you would buy for, let's say, 30,000 naira before. You go there and you now see that same thing is now 20,000 naira. And you're like, but can you watch cheap buy? Then somebody says, next year election, and you go, oh, abajo. Now, so it means that there is a way that people can hold sentiment, all right, on something. There's a way that people can hold a particular kind of thought pattern on something, and it can influence their decision on that thing. Do you get? So it happens like that too in the financial market. It happens like that too in my where people are not necessarily making informed decisions as they should. All right, they are not making, and that's why I compare this. Is like an earthman trading. You are just going where you are, where anywhere the breeze is blowing you. You get just following sentiment and all that. So it is possible people can trade like that. Is a kind of way, just as you started, it can be a form, all right, of analysis too and all that. So I believe you understand what I meant, the explanation about technical analysis, both technical analysis and sentimental analysis. So rather both fundamental analysis, pardon me, and sentimental analysis. Now we're going to look at um, technical analysis. What is technical analysis? Basically, when we talk about technical analysis, what are we talking about? So I'll just introduce that, and then we'll try to wrap up the class. So technical analysis basically is studying in the simplest form. All right, let me put it that way. Technical analysis in its simplest form is studying the past to predict the future. So technical analysis in its simplest form is studying the past to predict the future. Studying the past to to speculate on what the future will do. So you are studying past events, past occurrences in the chart. All right, in your chart, you are studying that to to you are studying that to now predict what the price would do in the future. Just like the popular statements that history always repeats itself. All right, that's a major statement that that technical analysis is built upon. That's a major statement that technical analysis is founded upon. History always repeats itself. History always repeats itself. Okay, so it means that because I know that history always repeats itself, in technical analysis, we now study that history so that by the time it is repeating itself, all right, it is an anticipated repeat. So we are expecting the repeat. You get what I'm trying to say? Our orders are ready. So it means that when we talk about technical analysis, largely we are talking about using the past to predict the future. Using the past to predict the future. Using the history of what has happened before to predict what is going to happen. Using the issue of what has happened before to predict what is going to happen. So I'm just going to run through what we saw today again. So we saw different type of market movement, and we saw the uptrend, the downtrend, and the ranging market. And we said in the uptrend, the market is making series of higher highs and higher lows. In the downtrend, the market is making series of lower highs and lower lows. While in the ranging market is moving between fixed support and resistance, moving between fixed prices. Prices, all right? Stay with that. It's moving between fixed prices, So we're able to see that. And in this slide, I want you to draw an assignment in this regard. You guys have, I want to believe that a large number of you already have MetaTrader 5 and you have your account logged in on MetaTrader 5 now. So I want you the accounts that you have. I want you to go on the chat and take screenshots. All right. So you take three. You check on three different commodities, three different currency pairs, and you take three different screenshots from each of them of from no each currency pair rather. You take two different screenshots. One when that particular pair is in an uptrend, another when it's in a downtrend. All right, so you do this for three different currency pairs. So you scroll back, you check that okay, it is an uptrend here, forming higher highs and higher lows. You take a screenshot. Then it is a downtrend here, taking forming lower lows, lower highs and lower lows. You take another screenshot, take a picture, and you send it to me online and all that. So please let's do that assignment. I'll be expecting it before by nightfall latest. All right. So back to what I was going over what we saw today. So we're able to see market movement, we're able to see the uptrend, the downtrend, and the ranging market. Then we're also able to look at the lots that we have. We're able to see that we have the standard lots, we have the mini lots, and we have the micro lots. So that the standard lot is 1, the mini lot, all right, is 0.1, while the micro lot is 0.01. And we look at how the price moves in pips, we expanded a little bit more on that today than we did yesterday. So price moves in pips. So price moves in pips, and we saw the relationship between your lot size and your pip. Now, let me say this as we round up the class, that the fact that you would see there that there are just three lot size that were listed: 1.0, the standard lot; the mini lot 0.1 rather, and the micro lot 0.01. Now that doesn't mean that one cannot use any other lot size, all right, to trade the financial market apart from these three. Not necessarily. It's just that these three are like what do you call the word? What's the word now? They are like they are like like principal, lot where you can draw, other lots that you want to use from. For example, now you can want to trade and you say you want to use a lot of 0.15, is okay. 0.27 is okay. You can say you want to use 0.535, it's okay. Do you get? So you have to understand that. So basically, that is relationship between lots and pips. So we also were able to see the relationship between lot and pips. But then I would have loved to give you another assignment under this also. However, I'll probably do that in the pre-recorded video when I'm sure that you can, I'm sure that you now understand the concept of pips and lots better. Then I will give you, an exercise to just, try your hand around it and all that. So basically, that is going to be like all for today's class. That'll be all for today's class. That'll be all for today's class. So thank you very, very much. And don't forget to submit our assignments latest by nightfall. Have a great day.